All right, good morning and welcome, everyone. I'm Jenny Eaton, the Program Coordinator for the Northland Small Business Development Center. Thank you for joining us for the Minnesota Paid Leave webinar to learn more about paid leave here at the end of 2025. I'll start with a few housekeeping notes real quick. This webinar is being recorded and it will be available on the Northland SBDC YouTube channel, and we'll send a link to the recording and the slides to all attendees after the presentation. If you have any questions during the presentation, please use the Q&A feature. We'll do our best to answer as many possible questions at the end, but you can ask questions throughout, and we will take a little bit of time at the end to answer those. Before we dive in, I'd like to share a little bit about the Northland SBDC services and how you can access them, and then I'll turn things over to Ravina, our lead presenter today. So Northland SBDC provides no-cost and confidential technical assistance to small businesses and entrepreneurs throughout the 7 Northeast counties in Minnesota. We can help people in a variety of ways, from understanding finances like cash flow and projections, describing customers, creating a business plan, and walking through the process of financing a business. We also have subject matter expert consultants available to work with clients one-on-one, providing no-cost assistance in specific areas such as marketing, human resources, technology, and QuickBooks. If you are a current small business owner or an entrepreneur looking to start a business, you can access our services by visiting northlandsbdc.org and clicking the red Request for Services button. And then we'll connect you with a consultant in your area to work with you one-on-one. So that's a brief overview of our services. Today we have Ravina Claxton joining us. She's our Northland SBDC subject matter expert in human resources, and she's going to give us some more knowledge around Minnesota paid leave. Ravina, would you mind introducing yourselves and kicking off our webinar?
All right. Thank you, Jenny, and welcome, everyone. Thank you for joining us this morning. The subject today, obviously, is Minnesota paid leave, and we want to make sure that our small business owners in our region and in our communities are ready for implementation. So we're going to be covering the basics of the Minnesota paid leave statutes. And we'll spend some time on the decisions that you are allowed to make about the implementation of paid leave in your businesses. There are some excellent workshops and webinars available from the state. Those recordings are out on the paid leave site. If you haven't gone to one of those or multiple ones, I suggest that you consider taking a look at those as well. But my perspective today on behalf of the Small Business Development Center is going to be from a couple of experiences in my work. One, I was a former leave administrator in companies where I had to problem solve leaves and return to work issues. And probably most specifically to this Paid Leave Act is that my husband and I have owned a small retail store in the Twin Cities for the last 17 years. So I'm very familiar with the financial implications of benefits, which you can and cannot do from a financial perspective based on your particular business and where you are in your cycle of business. So just going through a few of the basics. Next year, effective 1/1, Minnesota is going to be the 13th state to implement paid leave. But other states have other forms of paid sick leave, some more similar to earned sick and safe time. Some are voluntary leave coverages. So Minnesota paid leave clearly has its proponents and its opponents. But the intent of paid leave and why it's important for small businesses, if you've ever had this experience, I know I have. Without having a safety net of these kinds of benefits, sometimes our employees have to make decisions about their work. They can't stay working for us because they have to care for a seriously ill family member or a child, and then they quit. So it's designed to provide that safety net, financial stability, job protection for workers who have to take time off for a serious health condition. Maybe they're the only person to care for that family member, or for family bonding after the birth or adoption of a child. It ensures that Minnesotans don't have to choose between their health or their family's needs and livelihood. The key benefits are two things, and we'll talk in more detail about this, but partial wage replacement, paid benefits that come through the state or through an insurance carrier, and job protection, which strengthens families, communities, etc. And then when this was passed, it's important, I think, to recognize that it was designed to be a shared cost program like unemployment benefits. So those options are given to you as a small business owner or as a large business owner to share the cost with your employees. And in fact, they have made it easy to do that by having a joint account on the unemployment site, or a side-by-side account where those quarterly premiums can be paid more easily because you're going in there and doing your unemployment taxes as well. So again, the basics of the paid leave plan. It was passed in May 2023. And unlike earned sick and safe time, we have to recognize that nearly every worker in Minnesota is covered. So folks that have not been covered to date by things like earned sick and safe time, we're talking about church office employees. We're talking about daycare centers, perhaps, that have been sponsored by churches that are not in the unemployment system. We're talking about first responders who have been, up to this point, exempt from things like earned sick and safe time. We're talking about elected and appointed officials. So this is expanded coverage for our Minnesota workforce. Now, what's it for? It's for events, and important to recognize, earned sick and safe time is that, of course, that you're doing now is for I've got a cold, I can't come into work today, I've got the flu. It's for the here and there absences. But this is for serious matters, health events, or birth of a child, bonding leave, events that last at least 7 days. Everything says 7 days on the state site. When asked for clarification, which I did, the state clarified that's 7 calendar days. So that's an important definition to understand. It's for medical leave to care for your own serious health condition, perhaps a surgery. It's for bonding leave, leave to bond with an individual's child during the first 12 months after the birth or the placement of child through adoption or foster care. It's for military leave because a family member is on active duty. Excuse me. It's for care for a family member with a serious health condition, or it's for safety leave because of domestic abuse. Now, there is something that I'll call out, which is a little bit different. I've only seen one example cited by the state of a leave that could start in 2025 and still be covered under a Minnesota paid leave in 2026, and that's leave for bonding. So it would go like this. There was a birth of a child, and this is the father or the mother in your business. There was a birth of a child, let's say in July of this year, 2025, back in July. They would actually have until June 30 of next year to take that bonding leave to bond with the child. So it extends to that birth date into 2026. I had a question yesterday from a client who wanted to know about somebody having surgery in December that was planned to still be out in January. That's not something that has been addressed by the state yet, but it's certainly a worthy question to ask them. I don't know that anything else beyond bonding leave has been called out for that carryover. Benefit payments, if an employee qualifies and is certified by their provider, benefit payments are indexed. And that means that the lower your pay, the higher your potential supplement from the state. So Minnesotans can get up to 90% of their usual wages, up to a maximum of 1423. That's 2025 numbers. So lower wage workers are going to get more support. If you earn less, you'll get a higher percentage of your paycheck. If you're a higher wage earner, then you may be getting something more like 50%. So again, indexed. I'm not going to delve deeply into the exception for hospitality other than to say it is very narrow. And here are some examples of folks that work in the hospitality industry and businesses in that sector that may be exempt. It only applies to restaurants, hotels, motels, lodges, resorts, food stands, food trucks, mobile and seasonal food businesses. So it's food and resorts where they bring in most of the revenue within 6 months of the year. There's some gross receipts details that have to be met. Your seasonal hospitality employees must be employed no more than 150 days in a 52-week period. And it's important to note, I've had some businesses ask me, hey, I'm in a high tourist area. I run a retail store. I have seasonal employees. You're still, unless you're in this sector of restaurant, resort, et cetera, you're not going to qualify. But the qualification, if you provide the evidence to get that certification from the state that you are an exception, then that applies to individual employment, not to your entire business. So it would be by employee that you would get that exemption. So the request has to be submitted to the state. It has to be kept up to date. You have to, in your unemployment, when you go in and report quarterly, you're going to also have to submit that wage detail every quarter to prove that you're still seasonal. And of course, your seasonal employees then would not be able to, you couldn't take premiums and they wouldn't be entitled to any benefits. But here's the site to go for more detail because it is very narrow. But if you're in this industry, it's important for you to understand it. Now, here's another distinction that's important to recognize. There's a difference between being eligible for paid leave and having job protection. Here's how that goes. You're eligible for benefits if you worked 50% or more of the prior year in Minnesota, the rolling back a year. If you didn't work 50% or more of the year in any one state and you live in Minnesota, you're qualified. And you meet the annual state earnings threshold, which was set for $3,900 in 2025. What that means is that someone could come into your business and day two, and I've had this happen, and day two, they're out on leave. Car accident, break my leg on the ski hill, something of that nature. And they would still be eligible for benefits if they had worked for someone else before coming to you and had hit that earnings threshold. Now, that's the difference between eligibility and the job protection. They're not actually job protected by you until they've worked for you for 90 days or more. So in the unlikely event this happens, and again, it's happened to me over the course of my career, and that is, I've had to say to someone, I have to have someone in this spot, and you don't have that job protection yet, but they've got the benefits. They can go and apply and get those checks from the state. but I welcome you to reapply for your job when you are able to return to work. So that's an extreme illustration of the difference. So this is your to-do list, and we're going to cover each of these 5 points. Your to-do list by December 1, which is right around the corner, and I'm sure some of you have already done a lot of this. Maybe you've done part of it, and maybe you're just getting started, but you have to determine how you're going to offer the insurance. You've got 3 choices. You have to determine how you're going to share the cost, or if you're going to share the cost with your employees for the premiums. You need to set up your account, name your administrator. You need to consider some of these elective decisions that I mentioned that are unique to your business, and they're specified by the state that you can make this decision for your unique needs of your business. And then you need to notify the employees. We're going to go through each of these points. Point number 1, how are you going to offer the required insurance? The state of Minnesota has said you can do it 3 ways. You can get an equivalent plan through an insurance carrier. And if you go out on the Minnesota paid leave site, you'll see, and I've got a snapshot of this on the left-hand side, you can see that there are like 3 pages of approved equivalent plans from big insurance companies. They've applied with the state and said, we can offer this coverage. Now, you have to apply with the state to use an equivalent plan, which means you have to go to the carrier, you have to ask them to underwrite you for coverage, see if they will underwrite you, and then you have to go to the state and say, I'd like to offer this equivalent plan. Equivalent plan means that it works precisely the same way as the state's plan. But if you have, and I have some clients that have been in business and are fortunate enough to be able to offer health insurance, life insurance, short-term disability. If you have some other lines of coverage, your carrier might be willing to, and they're approved through the state, they might be willing to give you a good price on an equivalent plan. Just because it says that you have to apply by 11/15, that's just for 1/1/26 implementation. If you want to think about this going forward, and again, some of the insurance carriers will tell you privately, we really can't compete with the rates that the state is offering. But if you have these other lines of coverage, you may get a competitive rate. So it doesn't mean that you can't ever do it again if you don't apply by 11/15. It just means that it would be a quarter behind and you wouldn't be able to offer it until another quarter next year. You can opt to, and I should say that for this next option, as well as an equivalent plan, you have to pay a fee to the state every year for them to approve your plan. You can self-insure. You self-insure by offering a surety bond that has to be approved to insure your business and make sure that you can cover these costs. And you can go to the state website and find out the details of both these things. Or you can offer the state plan, which by far most of our businesses, especially our small businesses, are opting with. The second decision you have to make is whether or not you're going to cover, or how much of the insurance you're going to pay as the employer. Here are the considerations. The rules are, it's actually not the considerations, it's the rules. If you're a large employer, which means you're defined as having more than 30 employees, you have to fund at least 50% of the premium cost. If you're a small employer, you have the option of funding less. Small employer is defined as 30 employees or less. They look and make this distinction by looking at your wage detail that's supplied through the unemployment, your quarterly reporting. And they're going to look at the highest quarter where the highest number of employees you report in the last 4 quarters. So and determine this distinction of what it's the highest number is what your designation will depend on. You're a small employer if, again, you have 30 or fewer employees. Your average employee wage is 150% or less of the state average, which is 107,000 in 2025. And along with having a couple of different options, different than a large employer for this cost sharing, you also will have some availability of grants to help you with the cost of running this program in your business. So you should be named, you should be getting notifications. I believe they said it would be this month that you're a small business, small employer. And when you set up your account, and I'll talk about that in a minute, you should be able to see if you have a claim, you should be able to see any grant money that's available for you to take advantage of when you actually have someone that's made a claim. Now, the qualifications are you have to be deemed a small employer. The costs have already had to have been incurred. The funding isn't guaranteed. I'm sure it will run out before the end of the year, probably fairly early in the year. But some of the benefits include money per employee or per employer to hire temporary workers, to give more money for additional hours or additional coverage by your existing workforce, to train workers to cover for an employee on leave. So those are some of the things that may be available to you. But let's talk a minute about those options for cost sharing, because it can be a little confusing. When I first looked at this, I looked at 0.88%. I thought, oh my gosh, that must be 88 cents. No, it's not. There's a couple of zeros before that. This is actually the payroll tax. So if you're a large employer, your assessment of payroll taxes is 0.88. You have to, if you're over 30 employees, you have to pay at least half of that, or 0.44. That's the rule. You can pay more, and we'll talk about pros and cons of paying more, but you can't pay less. If you're a small employer of 30 employees or less, your premium is actually less. Your overall payroll tax is less than a large employer. It's actually 0.66% this year. You have the ability, you have to pay at least 0.22. You don't have to pay half. I'm going to show you another example of that. Your premium rate is applied on all the wages that are up to 176,000. That's a Social Security cap. The first premiums now, you'll start taking them out of your paychecks starting January 1, but they won't actually, those costs, just like unemployment, won't actually be due to the state until April 30th after the first quarter. This is important. Note, should be in red, flashing. Premium rates are set yearly, okay? The state has said, we're going to look at utilization mid-year every year. By July, our actuaries, and I'm certain that that's a general time frame, but by July, our actuaries are going to set the premium cost and the payroll taxes for the following year. I'll come back to that in a minute. Again, you as an employer can decide to fund 100%. You as an employer can change how much you're funding. It's just like ESST. If you don't like the way you're offering it, the front load or the accrual, you want to change systems, you can change it the next year. You can change how much you're going to supplement or how much you're going to share in subsequent years. But just remember, Under no circumstances can the premium deduction that the employee has ever result in them being paid less than the required minimum wage rate. Now, there's an estimator out there. It has its limitations, but you can go to it on the website, the Minnesota, it's the deed paid leave site. There's the address on the left, and you'll see a pop-up that looks like the box on the left, lower left. And for our business, this is what I entered, and this is what happened. $160,000 annual payroll, which was one of the boxes that you had to enter, 4 employees. And this is what came up in terms of how much it's going to cost me and our employees. You can see that the employer for family, and they split it. It's not just one rate. There's a portion that's set aside for family, and there's a portion that's set aside for medical. The reason they do that is that these benefits are taxed differently, so they have to be separated out. Okay, so this is what the rates came up for employer and for employees. You can see that was a total of 4. So obviously for family leave, they'd be paying $1 something. And medical leave, it'd be divided by 4, so it'd be $2 something. And so then you can see the totals. Now, one thing you need to understand is the small print says that the estimator is set for the large employer rate. So if you're a small employer of 30 employees or less, your rate's even going to be less. Here's another example that they used in the state, one of the state presentations, and this is for a higher wage earner, for someone earning $70,000 a year. And they're trying to show that, look, this is a very cost-effective benefit based on how much, contrasting how much I have to pay with how much my benefit would be if I need it. So if it was split 50% with the employer, my weekly premium at $70,000 a year is going to be $5.93. And here's what my weekly payment on leave would be. So showing the fact that it's a good investment, even though there's no opt-out. But anyway, here's an option that I talk about with my small business clients that are referred to me as the HR expert. If you have a handbook, or even when you give out the notices to your employees by 12/1, and we're going to cover that in a minute, you might want to think about just conveying language that says the cost, and this is just something I've been writing in handbooks, the cost of paid leave is set annually by the state. Your business name is going to determine their contribution to the cost of insurance each year and inform you accordingly. The remainder of the premium cost will be paid in the form of a payroll deduction by the employee. So I've been adding that to handbooks, if, and that's something for you to consider. Just again, based on experience, that gives you some wiggle room, because there's nothing worse than saying, oh, it's so cheap, I'm going to cover it next year. I'm just going to cover the whole thing, and then turn around and have the premiums really go up, or your business, take some hits, in other ways, and you can't afford it. And then you got to go to your employee and say, oh, guess what? I can't pay as much this year. So, kind of pre-populating that thought that we're going to set the rates every year may be helpful to your business. It's something to think about. So the next thing you've got to do is to set up your accounts. And there are actually 2 places you need to go to set up your account. You need to go to your unemployment site where you're paying your unemployment premiums and set up the side-by-side paid leave account. And that just gives you the place where you're going to go and pay your premiums every quarter, or pay your taxes every quarter. And then you need to go to the Minnesota paid leave account and set up your account. That's where you're going to look at more detail of who's filing for leaves. So this is a a graphic that's out on the Minnesota paid leave site. I think it's helpful. You can see that the account on the left is that joint unemployment account. It's called your employer account, just for your reference. That's where you submit your quarterly wage detail, you pay your unemployment taxes, you're also going to pay your paid leave premiums, you're going to review your unemployment applications. That's unemployment now. Going to designate a paid leave administrator. You can designate more than one. So just keep that in mind. And review paid leave applications. That's where you're going to need your paid leave website, this site that's over on the right. And so in that site, you're going to be looking at any applications that your employees have submitted and look at the determination that's been made by the state as to whether they qualify and how much they're going to be getting as benefit payments. That's also if you want a paid or if you want an equivalent plan, that's also where you would set or submit your request. Again, that site I showed you on the right, the Minnesota Paid Leave Portal. This is where you and your paid leave administrator can go in and see some detail like this that gives your employees who applied and their status. Now, remember that the state is very specific about the fact that if an employee applies for leave, they have to tell you first before they can go in here. You're going to tell them how to go in the notice, and I'll cover that in a minute. But before they can actually apply, they have to tell you, and the site, when they start the application process, that's the first question. Did you tell your employer that you need leave? And if they didn't tell you, they can't apply. Here's the claims process. Once, there is a 7 calendar day or more event that meets the criteria of what leave is for, as well as the fact that they are eligible, right? And we covered all that. They notify you about their intention to take leave. They start an application. They submit the application. Your paid leave administrator is going to be asked to review it. Then they adjudicate, the state adjudicates the application. In other words, determines whether or not they qualify. And then you'll be notified through that site that a determination has been made. Now, they've actually been doing, the state has been doing information sessions for providers, specifically for providers, and covering these documents that have to be turned in. And so there's a medical leave form, there's a birth and bonding leave form, there's a caring certification form, there's a safety certification form. And so this is the employee's responsibility. Those forms will be available out there. They have to get it to their provider. Their provider has to sign it and get it submitted to the state before they can be considered. That's all out of your hands. You're just watching the development in your site and watching the status. Now, I'm going to come back to the notices for employees here in just a minute because we want to be sure and have time for that. But here are some elective decisions that I mentioned that you can make for your business. And let me talk about the fact that when you make that determination about how much you're going to pay, you're going to want to think about a couple of things. You're going to think about affordability. I have some of my employers that are saying, they're just getting started in business. So I've only got a couple of employees. I'm going to charge them the most that I can charge, that 0.44%. I'm going to charge that, which means that I'm only going to pay about 20% of that 0.66 premium. I'll show the numbers here in a minute. But I'm going to make that decision based on my business and where I am. A lot of my employers are just saying, hey, I'm going to pay 50% just like the large employers. We're going to split it down the middle. And then I have a few employers that are saying, hey, I think I might want to just pay 100%. I've been around in business for a while. It's not that much, and I'm not able to offer other benefits. You need to think about the tax implications of that, which I'll cover in a minute. But that's an example of decisions that you're going to want to make for your business based on where you are and what your options are from the state. You also get to make a decision about intermittent leave. You can decide how long, and this is leave taken in days or hours for a serious health condition or one of those other qualifying events, but it's needed not in smaller increments. So I might have migraines that keep me from coming to work. I might have asthma. I might have a child that has the same thing. You have some latitude on what you can offer in terms of the length and increments of time. You can decide, and I'll cover that in more detail in a minute. You can decide what kind of notice you expect. The state says you can't ask the employee to give you any more than 30 days notice of a foreseeable leave. Foreseeable, gonna have a baby, gonna have surgery. But you can say in your handbook or in your policies, we require 30 days notice for foreseeable leave. Here's who you need to contact. You can offer substitution pay and supplemental pay, and I'll cover that as well. And you're going to want to make sure that you make it very clear in any written policies that Minnesota paid leave runs concurrently as permitted by law with any other leave that the employee might be eligible for. It's just a simple statement, but it covers leaves like parenting leave or family medical leave if you're a larger employee. You're going to want to always make sure to the extent covered by law so they're not backing up leaves on top of one another. All right. So again, continuous or intermittent leave, this is an example that the state shows. So you can see that continuous leave is a block of time they're out. And again, they can be out for up to 12 weeks per event. They can have 2 events in a calendar year. The second event, if it is a different event, can only then go up to a maximum of 20. It's not another 12 weeks. That's how much continuous leave is available. Intermittent leave can be taken, as I said, in smaller increments. But to qualify for intermittent leave, you must have been out at least 8 hours for that condition, or 30 days have to have passed. Now, the amount of time that's offered intermittently, you have to offer at least 12 weeks of intermittent leave. This whole leave package taken intermittently. You have to offer at least 12 weeks. You may require the rest of the time, that's up to 20 weeks for that second event, to be used continuously. In what increments? This is a little tricky, I have found. The state says the maximum increment you can offer paid leave in is 1 day. And the minimum is 15 minutes. That's what earned sick and safe time law says, that you don't have to offer it in anything less than 15 minutes. I've also seen on the paid leave site that you can offer paid leave in minutes. Now, they're not going to pay. They're going to pay once there is, some, there's a bulk of time to be paid. But there's also a caveat that the state has told me a couple times now when I've asked. Intermittent leave has to be taken in increments that are consistent with the established policy of the employer to account for use of other forms of leave. So, in other words, if you let employees take PTO They don't come to work for a full day or full shift, and because they've got something going on, and so they get a full, in order to get a full paycheck for the day, you allow them to draw off of their PTO or their vacation bank or their ESST bank if it's for a qualifying, ESST reason. There's a suggestion made by the state that you need to offer the same increments. So I would be thoughtful about that. Now, I have employers across the spectrum. I have employers that say, oh no, I need to specify it needs to be taken in one day or half days because I just don't have the accounting capability to go down to minutes. I have other employers that are saying, no, for my business, I have such a shortage of staff. If they can come to work partially, I am happy to allow the whole complement of paid leave to be used intermittently because I'm just thankful that they come in and work partial days. So again, you have to decide on that for your business. Substitution and supplemental pay. Substitution pay is a useful concept. The state, when they first started doing their workshops, they talked about it. You have to recognize that there's no waiting period. Like work comp, there's a waiting period, I think, of 7 days. A lot of short-term disability plans, you have to wait before you can get a payment from the state or from the carrier. There isn't a waiting period for Minnesota paid leave. So in the event it's not foreseeable, I go on the ski hill and I break my leg, I'm going to be concerned about other things besides applying for leave. So the concept of substitution leave is that they contact you and you let them take whatever time they have available, benefit time, to have a paycheck. Now, if they have benefit time, the state also says you can't restrict them from using it. They need to be able to use all of their time. But the concept of substitution, I think, is useful because just like unemployment, when they file for unemployment, you have to report, if you're an applicant, you have to report any other pay that you've received. And so if they're getting pay for those first few days from you, you're letting them, take their vacation or PTO, ESST, whatever benefit time they have, they're going to have to report that and they're not going to be double paid. The employee can also choose not to file. They don't have to file. Now, they have to pay the premiums. They can't opt out, and neither can you, but they could choose not to file and just take their benefit time. Now, concept of supplemental pay is important because that's top-off pay. That you are not required to offer it. Again, I'll say it again. You're not required to offer supplemental pay, but you want to make sure your employees know whether or not you're offering that. Supplemental pay is just like, okay, I've been qualified by the state. I'm only going to get 50% of my regular check. I want to get the rest of I need 100% of my regular pay. So I want to draw off of my available PTO, ESST, vacation, whatever you call it, if they have that benefit time. You don't have to allow them to do that, but you want to make sure that employees know that. Okay. And I have been writing in handbooks, we won't allow you to take supplemental pay until a benefit determination has been made by the state, because the state has been very clear about saying you can't go over the total amount that you usually get paid. You can't have a greater than average payday. So if you don't know the benefit determination, if they're going to get 50, 75%, et cetera, until they get that benefit determination, you may not want to offer that supplemental top-off pay, so you don't have to go back and collect it if you overpay. So wait for the benefit determination if you're going to offer supplemental pay. You have to be careful when you go back, and I often, when I'm helping employers with these kinds of statements or ESST or paid leave in their handbooks, the rules about use, you have to be careful that you don't restrict work or use. And PTO all-in plans, PTO can't be used during your probationary period. If it's available, it has to be used. You have to start thinking about some of this language in your handbooks, because with ESST and paid leave, the restrictions you place on use of benefits is not what it used to be. So those are some things that you need to be, without getting in further detail due to a lack of time, it's just something to be aware of. Now, last section here today, notifying employees. The notices are available now, whether you have an equivalent plan or the state plan, you have to give out these notices by December 1. They're on the website. They look like this. They're on the paid leave site. They look like this. You need to be sure you use the right one, because the first one is for large employers. The second one, and I think it starts on about page 7. It's all one file. The second one is for small businesses, small employers. This is an example of how, and on page 2, the first page is a lot about, hey, this is what it's used for. Here's how here's how you qualify, etc. But when it comes down to filling out the second page, this is what's a little tricky, because our employees don't think of percentages of premiums. They think about dollars and cents. We do too. So here's how you would fill it out. And I've gone through these with the state just to make sure that I was thinking of it properly. So if you want to share 50-50 of your 0.66 premium cost, because you're a small employer, want to share it 50-50, you put your employer's name there where it says employer's name, and you can see there's the total medical leave, the total family leave, and you're going to want to say 50% of each of those. Total of 0.33% is their payroll tax rate. That's how much it's going to be deducted from their wages. That's how you would fill that out. If you want to charge the max, maybe you're just getting started in business and you're concerned about affordability, you want to only pay about 20% of this, you want to pass on the maximum charge, this is how you would fill it out. You're sharing it, the employee's share is 0.44. You're going to show how much of that 0.46 is split. It's 0.31 and 15. It's 0.13 and 0.07 for the family leave contribution. And this is what would need to be filled out for that maximum contribution by the employee. Here's the large employer. This is where it really gets dicey, because you got to show the exact 50-50 split for the large employer over 30 employees premium rate. 0.305%, 0.135%. Total deducted from your wages is 0.44. So I've got those examples of that I can go through with our employers if you want to, want some additional assistance, but that's how you would fill those out. Now, once again, when you're trying to figure out how much of this you really want to pay, if you're thinking about 100%, whatever you're thinking about, you need to read taxes and paid leave. This is out on the website. It's a document that you can download. The last one was updated October 1st. This is the tax and paid leave treatment. This tells you how to complete the W-2s that you have to send out at the end of the year, and what you'll be getting from the state if your employees get some sort of benefit payment in the form of a 1099 or whatever. But you're going to want to also make sure that whoever's doing your payroll, if you've got a bookkeeper, accountant, a payroll service, make sure they're familiar with this too. Okay. It's easy. It's harder to explain, but easier to read and understand. But here's some I want to point out to you, because it talks about, again, the treatment of premiums. That's the deductions, and the treatment of benefits if they qualify and they get a benefit payment. If an employer pays more than the required minimum share of the premium, this is considered additional compensation to the employee and is included in the employee's federal gross income as wages. That's one of the fine print. And I think that's something you need to be aware of if you're thinking about paying more than the required amount. And it might not make a hill of beans difference in with a lower paid employee, but for a higher paid employee, those additional dollars going on to their wages, their gross income as wages might make a difference. So be aware before you make these decisions. And finally, we're going to have about 7 minutes for questions, but there's the poster that's available. You got to make sure you get it put up because there are fines for not posting posters, required posters. And this one is available as a download on the paid leave site. So once again, that's everything. And Jenny, you want to jump in there and we'll take a few questions and talk about additional info?
Yeah, got some really simple ones too, kind of yes or no ones. For the 30 employees or less for small or large employer, is somebody was asking if it's 30 FTEs to qualify or just 30 or more employees in general, whether they're part-time or
It's
full-time.
bodies. It's bodies. Mhm.
Perfect. And then in regards to when you had mentioned if someone had a child last year, say last July, in 2025, and they say they already received paid leave from their employer too, is that kind of irrelevant for 2026? They still are eligible for that bonding leave, correct?
Yes, correct.
Okay.
For just the overlap. I mean, whatever date that they had their baby in 2025, it's only for 1 year into 2026. So, again, baby in July, they only have until June 30 to use the bonding leave, even if they've had leave from you already.
And do you know if the state is withholding, if the state is going to be doing with any withholdings from their payments, child support, health premiums, or garnishments from the paid family medical leave payments?
Oh, good question. That's a question I don't know.
And I think I sat in on a webinar recently, and it's still something to look into more that addressed that they would not be holding any premiums. It's still the employer's responsibility, but that's something definitely to explore more too.
Right. And I have to say that they know my name at paid leave because I've sent a variety of different emails into them. And you just go to the website and send them an email. They send you a confirmation they've received it. And they've been very good about getting back to me with with answers to my questions within a couple of days, sometimes the very next day. So that would be something, if you've got some employees that would apply to, that's a good question to have answered. In fact, I'll probably ask it myself after the workshop, so I'll know. But that would be something they could address.
Perfect. And then let's see, another one. Somebody had asked about how the 30 that number of employees are determined. But I think I remember you mentioned they're going to look at the last 4 quarters that were reported and the amount of employees listed during those previous 4 quarters, correct?
Correct, for the highest quarter, and they'll
Okay.
use the highest quarter um, for that determination.
And do they look at that every quarter? So say 4 quarters ago they had 31, but then after another quarter they haven't showed more than 30. I don't know
Oh,
how.
because of the rolling aspect of it. I'm guessing that they look at it rolling, but I'm not for sure.
Okay.
That's another good question for them. But I'm guessing it's more of a rolling because that would make sense, the most sense to me.
And we have a couple questions about owners. Are owners' wages exempt and can owners opt out of paid leave? Um,
Owners are specifically called out in the statute. And I don't know that you can opt out. It probably depends on how you pay yourself. That's another good question for the state.
I understand an owner could be, under escort, they could be on payroll, or if they're just a single member LLC,
Right.
they may be.
It may depend on your formal status.
Okay. And then I'm wondering if the employer will have to break apart the premium and in their deduction between the family leave and the medical leave, or will the state figure that? So when they're taking the deduction, can they do it all as one, or do they break them apart on their payroll deduction?
I would guess that it's probably all in one, but I don't know that for sure either. Um, that would be something that, I think they're trying to make it really easy on the unemployment side when you go in and pay the premiums. I can't imagine that they would ask you to calculate all that specifically. It seems like it would just be a total amount, but I've not been asked that question before, so I don't know.
Okay. And let's see. And there was a question about where they find the information to apply for the grants after January 1st for small employers. I think you'd mentioned something about it being on the website.
That should be in your portal because you should be receiving notification that you're a small employer. And when you go into your portal, I've been told that you should be able to see what's available out there based on, um, you won't be able to see it until you actually have somebody apply. And once they're going through that adjudication and has been figured out, and somebody qualifies, then you can see how much grant money might be available to you to cover for that. So I think it has to be pretty far along in the process before they'll be notifying you within that portal what's available.
Okay. All right. Thank you, Ravina. And we do still have several questions, quite a bit on this topic because it's such a big big topic to be discussing. But we do we're going to wrap up this webinar just to stay on time here. I do want to mention that Northland SBDC, we do offer our services free of charge for small businesses. So if you need additional one-on-one assistance, whether with general business or with your human resource consultant or QuickBooks, you can register for services on our website. That's what this slide is here on the request for services button. So to get more just one-on-one help, maybe with specific things to your company, go ahead and register for services so we can connect you with Ravina or our QuickBooks consultants if it's something regarding payroll. Um, but that is everything for today. So just a reminder that you'll get a link for a survey that will pop up on your screen as you close the webinar. And we'd appreciate your input by completing this survey. More info on upcoming trainings can be found on our website, northlandsbdc.org, on our trainings calendar. And then again, for further technical assistance, just go ahead and register for services on our website, northlandsbdc.org. Thank you, everyone. Thank you, Ravina.
Thank you all.